Inflation is an economic phenomenon that affects all aspects of our lives, and investments are no exception. It can be a silent killer of your investments if you are not careful. Inflation erodes the purchasing power of money over time, so the value of your investments can also decline. Understanding the impact of inflation on your investments is essential if you want to protect your wealth and maximize returns. What is inflation and why does it matter for investors? Inflation, in simple terms, refers to the general increase in prices of goods and services over time. It is an economic concept that affects all aspects of our lives, including our investments. But why does inflation matter for investors? Well, inflation has a direct impact on the purchasing power of our money. As the cost of living rises, the value of our money decreases. This means that if your investments do not keep pace with inflation, their real value will decline over time. For example, if you have $100,000 invested in a savings account that earns a 1% return, but inflation is at 2%, your purchasing power effectively decreases by 1%. Inflation can also have a significant impact on different types of investments. Some investments, like fixed income assets such as bonds, may see their returns eroded by inflation. On the other hand, certain assets like real estate and commodities may be able to better hedge against inflation and retain their value. Understanding the impact of inflation on your investments is crucial for investors to make informed decisions. By considering the effects of inflation, you can protect your wealth and maximize returns. In the next sections, we will explore different strategies for protecting your investments from inflation, examples of how inflation has affected historical investments, and tips for staying informed about inflation trends. The effects of inflation on different types of investments. Investors need to be aware of the impact inflation can have on different types of investments. While inflation erodes the purchasing power of money over time, its effects can vary depending on the asset class. Fixed income assets, such as bonds, are particularly vulnerable to the effects of inflation. When inflation rises, the interest payments received from bonds may not be enough to keep up with the increased cost of living. As a result, the real return on these investments may decrease, ultimately reducing their value. Stocks, on the other hand, have historically been considered a better hedge against inflation. Companies can raise prices and generate higher revenues when inflation is present, allowing their stock prices to potentially increase. However, it is important to note that not all stocks may perform well during periods of high inflation, so careful selection and diversification are crucial. Real estate investments have also been seen as a way to protect against inflation. Property values tend to rise along with inflation, allowing investors to maintain or even increase their real estate holdings' value. Additionally, rental income can increase as housing costs go up, providing a reliable cash flow stream. Commodities, such as gold or oil, have long been considered inflation hedges. These assets have tangible value and are often in high demand during periods of inflation, as investors seek to preserve their wealth. However, commodity prices can be volatile and may not always correlate perfectly with inflation rates. Overall, understanding how inflation can affect different types of investments is essential for investors. By diversifying their portfolio and selecting assets that can better withstand inflationary pressures, investors can better protect their wealth and potentially maximize their returns. Strategies for protecting your investments from inflation. When it comes to protecting your investments from inflation, there are several strategies you can employ. First and foremost, diversification is key. By spreading your investments across different asset classes, you can reduce the risk of one particular investment being adversely affected by inflation. For example, consider investing in a mix of stocks, bonds, real estate, and commodities. This way, if one asset class underperforms during times of high inflation, the others may help offset any losses. Another strategy to consider is investing in inflation-protected securities, such as Treasury Inflation-Protected Securities, TIPS. These bonds are designed to keep pace with inflation by adjusting their principal value based on changes in the consumer price index. This means that as inflation rises, the value of your investment in TIPS will also increase. Furthermore, you can invest in companies that have a track record of successfully navigating periods of high inflation. Look for companies that have a competitive advantage, strong pricing power, and a history of increasing dividends. These companies are more likely to withstand the effects of inflation and continue generating returns for investors. Lastly, it is important to regularly review and adjust your investment strategy based on inflation trends. Stay informed about the current inflation rate and make any necessary changes to your portfolio. This could include rebalancing your investments, reallocating funds to assets that are better suited to weather inflationary periods, or seeking professional advice. By implementing these strategies, you can better protect your investments from the silent killer of inflation and potentially maximize your returns in the long run. Examples of how inflation has affected historical investments. Throughout history, there have been numerous examples of how inflation has impacted investments. One notable case is the hyperinflation in Germany during the early 1920s. Prices skyrocketed to astronomical levels, and people had to carry wheelbarrows full of money just to buy a loaf of bread. This devastating inflation wiped out the value of cash investments and forced people to turn to alternative forms of currency or assets like real estate and precious metals. Another example is the inflationary period in the United States during the 1970s, commonly referred to as the stagflation era. The combination of high unemployment and rising prices put a strain on investments. Stocks and bonds struggled to keep pace with inflation, while assets like gold and oil performed well. Many investors had to adjust their portfolios and seek out inflation-resistant assets to protect their wealth. More recently, Venezuela has experienced hyperinflation, reaching an annual inflation rate of over 1,000,000%. This extreme inflation has devastated the economy and caused the value of investments to plummet. People have resorted to alternative forms of currency, such as cryptocurrencies, to protect their savings from losing value. These historical examples serve as cautionary tales and highlight the importance of understanding the impact of inflation on investments. By studying past experiences, investors can learn valuable lessons and implement strategies to protect their wealth from the ravages of inflation. Tips for staying informed about inflation trends and adjusting your investment strategy accordingly. Staying informed about inflation trends and adjusting your investment strategy accordingly is crucial for protecting your wealth and maximizing returns. Here are some tips to help you navigate the ever-changing landscape of inflation. 1. Stay updated. Regularly monitor economic news and inflation reports. Keep an eye on key indicators like the Consumer Price Index, CPI, and Producer Price Index, PPI, to gauge the direction of inflation. This information will give you valuable insights into how inflation might impact your investments. 2. Diversify wisely. Diversification is key when it comes to protecting your investments from inflation. Spread your investments across different asset classes and industries to reduce the risk of inflation negatively affecting your entire portfolio. Consider investing in a mix of stocks, bonds, real estate, and commodities to help offset any losses during inflationary periods. 3. Focus on inflation-resistant assets. Certain assets have historically performed well during periods of inflation. Consider allocating a portion of your portfolio to inflation-resistant assets like gold, real estate investment trusts, REITs, and dividend-paying stocks. These assets have the potential to preserve value or even generate income in the face of rising prices. 4. Review and rebalance. Regularly review your investment portfolio to ensure it aligns with your long-term goals. Rebalance your portfolio by reallocating funds to assets that are better suited to withstand inflation. This might involve reducing exposure to bonds and cash and increasing exposure to stocks and inflation-protected securities. 5. Seek professional advice. Consider consulting with a financial advisor who can provide expert guidance tailored to your specific financial situation. They can help you navigate the complexities of inflation and recommend suitable investment strategies. By following these tips, you can stay ahead of inflation trends and adjust your investment strategy accordingly, ensuring your investments are protected from the silent killer of inflation and potentially maximizing your returns in the long run.